What's up everybody, Genix Dividend Investor here. In this video I'm going to tell you how the right stocks can give you a growing stream of passive dividend income potentially forever, starting now and for generations to come. Feel free to use the timestamps if you want to jump ahead, and I'll open by saying Happy Thanksgiving to everyone who just celebrated it. The whole idea of feeling grateful and enjoying a good turkey dinner is actually what inspired today's topic, the golden goose. I think that selling shares for income is like eating your turkey because once it's gone, it's gone. But a golden goose keeps producing and makes you feel grateful year after year, and that's exactly how dividends work. In fact, that's why Rockefeller, the richest man in US history, said that the only thing that gives him pleasure was seeing his dividends come in. He would have been worth about $500 to $600 billion in today's money, eclipsing everyone alive. So the point is that if you can build a portfolio of strong, reliable dividend-paying companies, you're basically raising your own flock of golden geese. And unlike real geese that usually only live about 20 years, good companies can last for centuries. Like I own Procter & Gamble and Colgate-Palmolive, both of which have been paying dividends every year since the 1800s. Each goose lays golden eggs every month or quarter, which you get as a cash dividend payment. You can eat the eggs, aka spend the dividends, or you can let them hatch into more geese, which is basically the same as reinvesting your dividends and buying more shares. I'm retired on dividends, so I'm mostly eating my golden eggs, but I still reinvest a small portion to help my portfolio flock grow a little faster. The amazing part is that even when I spend all my dividends, my portfolio has still tended to grow over time. That's because good companies keep growing, which means the value of my stocks usually goes up, and they keep raising their dividend payments, which means my income keeps going up as well. And here's where the real magic shows up. If you focus on good companies that raise their dividends consistently, those eggs don't just keep coming, they keep getting bigger. Your passive income grows on its own, even if you never add another dollar, though the more you reinvest or invest, the faster everything grows. Eventually you reach a point where the dividends alone can cover your living expenses. At that stage, you're living off the eggs, not the goose. Your portfolio stays intact, keeps growing, and keeps paying you. That means you're not slowly selling your assets, but instead living on their ever-increasing cash flow. And why is it more important than ever to create a stream of growing passive income? Well, this article that came out today explains it nicely. It says that despite having the most wealth of any generation, many baby boomers' assets won't last them through their retirement. Basically, they've been hit with soaring inflation, stagnant salaries, and a high cost of living that's dragging them out of their non-working years and back into the office. In fact, about 14% of baby boomers and older Gen Xers have already unretired, and another 4% are considering it. These folks are being forced to find new ways of making money, from taking on additional work, delaying retirement plans, and even returning back to work. Or this article that just came out, which says that many Americans earning six figures are feeling squeezed as the rising cost of living forces those in top income brackets to cut back on expenses and look for ways to stretch their dollars. This includes 30% of people making more than $200K a year. Now these are people who are obviously bad at living within their means, but it's still crazy to see. It's like they're earning a massive turkey dinner every year, but because they eat it all, they're starving by January. It's said that 49% of those high-income earners are skipping a social event so they don't have to split a check, 48% have pretended that apps like Venmo and Zelle weren't working to dodge a payment, and 45% of them held off on medical care due to costs. So to stay financially afloat, 61% of high earners are currently doing, or are considering, side hustles, 53% are selling personal items, 41% are skipping meals, 41% are renting out all or part of their home, and 38% are resorting to debt consolidation or bankruptcy. In fact, 45% of people making $200K plus a year are routinely using buy now, pay later services, and about the same amount relies on credit cards to make ends meet. Again, I personally think that's probably mostly from people who are terrible at managing their finances, but it's still eye-opening. One big lesson you should take from this is how important it is to resist the urge of lifestyle inflation as you make more money, and the other lesson is that you gotta invest so your money can start working for you. Clearly, we're living in times where we have to figure out ways to make more money, both now and in the future, and I found that investing is a great long-term way you can make it happen. Yes, your job will probably be your main income source for the majority of your life, so while that great income is pouring in, it's vital to live under your means and invest what you can into good assets. A key point is that those high earners are stuck on the treadmill because they probably don't own enough producing assets. They have high income, but probably aren't driving enough cash into stocks which could capture that value and generate additional cash flow for them going forward. And since I prefer stocks, let's talk about how you can build your golden goose with them. At a high level, I think the easiest path for most folks is to put their investable cash into a broad market ETF like the SP 500 and stick with it for the majority of your life. I'll call this your accumulation phase. During that phase, the main idea is just to keep buying, staying consistent, and growing your base. Most people don't want to spend hours researching stocks, so an ETF like VU is usually the simplest and safest way to go. Then, as you get closer to retirement, you slowly can shift into some higher yielding but still high quality tickers like many blue chip dividend stocks are, and maybe a small portion in income ETFs if you understand the risks. This is where diversification matters if you own single stocks, because you don't want one bad stock dragging everything down. And if you invest for long enough, you can get to a point where you never have to sell shares and instead live 100% on dividend income. Or maybe you'll follow a hybrid approach where you get some dividend income but still sell a few shares here and there. If you start young and invest for decades, I'm confident you can grow your portfolio big enough to live off dividends forever, though of course it depends on your expenses, where you live, your family, all that jazz. And yeah, you can always move somewhere with a lower cost of living like Thailand or Mexico to make that dream a whole lot easier. The key is to keep investing in decent assets for as long as you can, because time and compounding do a lot of the heavy lifting. And even as you move into retirement, it can be smart to keep reinvesting a portion of your income to keep pushing your numbers higher. During the accumulation phase, you'll probably want to lean towards higher growth investments. That might include some individual stocks if you're comfortable with the risk, either pure growth names with no dividends or fast dividend growers with lower starting yields. Lump sum or dollar cost averaging both work, but most people end up DCAing in just because that's how their money comes in. And once you're nearing retirement, you might choose to shift from broad market ETFs into fairly valued high quality blue chips that offer stronger current yields. For example, let's say you're 34, you've got a steady job, and you're able to put $500 a month into a Roth invested in a broad market fund. If you earn an annualized return of 10% over the next 25 years, you'd end up with roughly $590K in your portfolio. Then you could decide to move into individual tickers, so you create a portfolio of 20 to 30 tickers with an average weighted yield of 5%. So just a bit higher than mine in retirement, so perhaps you lean a tad more into income ETFs, or whatever you think. At that point, your portfolio would be throwing off almost $30,000 a year in divvies without you touching the principal. Now, of course, that's not enough for most people unless they move somewhere overseas where expenses were cheaper. And you might not want to move, but if your goal was to live off dividends forever, then you need to make some compromises. And you could always do the 4% rule, as that should last most people for at least 30 years, but I'd personally rather avoid selling shares if I could. But that's just me. I'm also someone who's cool to move somewhere more exotic, but each person needs to do what makes sense for them. The point is that the more you stay focused on investing, the more it opens up options for you down the road. I got to a point where my dividends cover all my family's expenses, and I started from zero. I began by investing in my company's 401k to get the match and the tax benefits. Then I invested a little more into a taxable account whenever I could, focusing on individual stocks. When I switched jobs, I'd roll my 401k into a self-directed IRA, going into individual tickers because I was comfortable taking on that risk. I also formed an investing club with some friends and relatives, and I stuck with investing for over 30 years. And that brings me to today, where my accounts are worth about $3.5 million US, most of which came through compounding over time. Plus, I always paid off my credit cards and lived within a budget, and whenever I got a bonus at work or sold a home or whatever, I'd keep investing as a key financial priority and focus. Almost all of my 29 tickers are blue chip dividend stocks, and feel free to watch my prior videos if you want to see my portfolio in fidelity, though don't copy me. And even with blue chips, you still need to make sure the companies you're picking have good growth capabilities, solid financial trends, and strong long-term prospects. All of that can enable a rising stream of income that can allow you to retire on dividends, either fully or partially. For example, here's the income from my portfolio from about when I started my YouTube channel. You can see a nice upward trend that came from reinvestments, some additional contributions, lots of dividend hikes, and some shifting into income ETFs. This month I'll make about $12,500 in dividend distributions, which is just a bit under my monthly average. At the end of the day, choosing the right investments isn't necessarily about chasing the highest total return or the highest dividend growth. The right investments are the ones that match your personal needs, goals, risk tolerances, and timelines. And the fact is that your goals are probably different than mine. I mean, most people focus on total market returns, and that makes sense. Though if you want to beat the market, then things get more nuanced than that. I mean, it's not too realistic to think you'll beat the market over the long term if you're talking about total market returns over the decades. However, it is easy to beat the market depending on what metrics you're talking about. Like my portfolio's average weighted yield is 4.3%, and if my goal is yield right now, then I'm beating the market right now as its yield is only around 1 to 2%. So yeah, each person's goals are unique to them, though be careful of not targeting all high yield stuff, as that's usually fraught with risk. For most people who want to succeed as a dividend growth investor, you've got to think long term and be ready to hold your stocks for years and years. That's because the key point of dividend growth investing is to build an income stream that keeps rising over time. You want your buying power to keep increasing, which means you want your dividends rising faster than inflation on average. But that only happens when you pick the right companies. You can't just buy anything and expect it to grow forever. You need businesses that can actually keep increasing their earnings and are focused on paying an ever-increasing stream of dividends. The best dividend stocks are often the ones with a long history of growing earnings and growing dividends. Of course, best is subjective, so one person's best might mean more dividend growth, while someone else might care more about yield plus stock appreciation or whatever. Ultimately, the more informed you are as an investor, the better decisions you're going to make. And I know that for some folks, it can be boring to research companies, and if that's you, then the easiest thing is probably to stick with ETFs. But if you do go with single stocks, then you got to understand how a business has been financially trending and ultimately performing, and if its earnings and cash flow are growing, and if you think it could keep growing nicely in the future. You want to know how much of its payouts go toward the dividend, and if that dividend looks sustainable and able to keep growing. It also helps to look at the company's leadership to see if management has a solid track record. You should check whether the business has any real advantages or a moat that help it stay competitive over the long haul. It's worth seeing how the company held up during past recessions and whether it's been buying back shares or diluting shareholders. And you need to understand its debt profile, its competitors, and whether it's overpriced, underpriced, or fairly valued. My favorite way to check valuation is by using fast graphs, since it quickly and visually shows me how a stock is priced compared to how the market has valued it historically and how it lines up with different fair value methods. I'm actually an affiliate of fast graphs because I like the tool so much, and my link is in the description of the video. Anyway, the point I'm trying to get across is that investing isn't a one-size-fits-all thing. And because your goals and timelines and such are unique to you, it's understandable for your portfolio to also be unique to you. Regardless, make sure you invest with a long time horizon, because in the short term, stock prices are often volatile and frequently not exactly what a business is worth. And don't go into investing with the mindset that you're gambling and trying to find a company that will 100x. Sure, that's nice if it happens, and yes, look for great underpriced companies, but focus on investing in great businesses at decent prices and you'll probably do a lot better over the long run. Follow Buffett's lead and invest like you're an owner who plans to hold their tickers for decades. Over the long run, stock prices will gravitate towards earnings, so invest in companies that can grow. And be aware of how emotions can impact your investing. If you want to live off dividends forever, then you need to also become a master of your emotions. If you don't, then you're more likely to panic sell or panic buy. This market cycle of emotions can give you some insights into how things often play out. On the left is a picture of how your emotions hit you during bull markets, where first you're optimistic, then excited, then thrilled, and then euphoric with your gains. That's actually the point of maximum financial risk when you're feeling the best, because inevitably things will crash. Then you probably become anxious as things fall. Perhaps you're in denial. Fear probably shows up next. And if it keeps going down, maybe depression, perhaps even panic. And usually, when people have run for the hills and panic sell because the sky is falling, that's exactly when it's often the best time to invest. It's tough not to sell sometimes when things are looking grim. I've tried to condition myself to just keep investing in all market conditions and not worry about what the market does in the short term. I just try to focus on my companies and try not to worry about what I can't control. Long-term focused investors know that when things have fallen and are underpriced, that's usually when you want to push in hard. That might be when your emotions change from despondency and desperation from the crappy market and into one of hope again. If the rally continues, then you usually feel relief and eventually get back to optimistic. And that emotional cycle often repeats over and over, usually with stock prices trending up over time. So where are you on this emotional chart right now? Leave me a comment and tell me what you think. What I know is that if you stay patient and keep feeding your golden goose instead of eating the turkey, you can eventually get to a point where the eggs cover much or even all of your expenses. And one of the things I'm very grateful for is that I started investing decades ago and never quit, even when I wanted to stop when my portfolio tanked. So I hope you had a happy Thanksgiving if you celebrate it, and regardless, I now ask that you do me a small favor and hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Moving on, now I'd like to call out my newest channel member, Tim Lambert, who just joined up. Moving on, now I'd like to show my gratitude to subscribers who left me kind comments, and we're going to shout out 10 who've done just that. So thank yous go out to Julia Hart, Donald Comer, Joe Velasquez, A Day with Roger Churton, Money and Life TV, Racer X, Arthur Malonis, Raw Amin, Dave Clark, and multiple from Eingram. Thanks folks, I really appreciate it. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 86 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.